Delta weighting portfolios, beta weighting conversation, Jedi options here today. Tyler Craig, take it over.
All right, yeah. So the challenge is going to be, how do you make a topic as big as this into a nice little 10-minute, 15-minute segment? I think I could do it. I think I could do it. This can get complicated in a hurry. We're going to keep it very simple as we do in Jedi Options. The concept that Matt introduced here was that of measuring your exposure. Measuring your exposure. It is one thing to say, I'm kind of bullish, I'm really bullish, I'm neutral, I'm mildly bearish, moderately bearish. Those words are very fuzzy. They're very subjective. You want to get to the point in your trading and your understanding of how to trade and invest to be able to quantify, right? So quantifying exposure, quantifying, how much you're going to make or lose on any given day. When it comes to things like that, like risk metrics, this is what the Greeks are all about. This is what the options Greeks are all about. And there also is some applicability to stock trading as well. And so the Greek delta really is all about your directional exposure, which for most people is first and foremost in their mind, right? Like, directionally speaking, if the market goes against me, how much money am I going to lose? If the market moves favorably, how much money am I going to make? Delta allows you to put a number on it, right? That's all. You can just put a number on it. And then you can track that number and know, as that number goes up, you have more exposure. As that number goes down, you have less exposure. And then as you pay attention day to day to day, as the market does what it does, you start to get comfortable with essentially translating that number into a certain profit and loss. So you can say, hey, I know when my delta is X, I make or lose about $100 a day. I know when my delta is Y, on a typical day, I make or lose $500. And then that gives you a great degree of control over how much volatility, how much fluctuation in your portfolio value you experience. What I love about this conversation is it underscores that there are things that you're in control of and there are things that you're not in control of. Okay. I'm not in control over whether the market goes up or down today. I am in control of what impact that has on my overall net worth, quite frankly, my overall portfolio value, because I'm the one who gets to decide how many trades to do, what size those trades are, and in aggregate, how much exposure I'm taking. And then, to Matt's earlier point, you can dial that up and down depending on your bias. The S&P 500 broke the 50-day moving average a week or two ago. If you said, look, I need to dial down my overall exposure, you can look at your delta number and you can wave a wand or do a few adjustments and you can lower that overall exposure. So conceptually, that's really where this topic will help you as a trader. Now for some definitions, okay? So delta measures basically how much money you will make or lose if the stock rises $1, okay? And this can be expressed in multiple ways. Some people will say I have a 0.5 delta, which means I make 50 cents per $1 move in the stock. $1 move in the stock. Sometimes we will multiply that and just say, hey, I have a 50 delta, which means I make $50 per $1 move in the stock. You can express it different ways, but in Thinkorswim, they kind of do all the math for you. And when you're looking at your monitor tab and you're looking at a specific position, they usually just express it in dollar terms. If your delta is 20, you'll make $20 per dollar increase in the stock. Your delta is 50, you'll make $50 per dollar increase, because they're essentially looking at the overall position in terms of number of contracts or number of shares. Okay, so essentially, positive delta is a bullish position. You're making money if the stock goes up. Negative delta is a bearish position. You're losing money if the stock goes up. Okay, the bigger the number, the more exposure you have. Okay, and so fundamentally, if you have, let's say, position A, if you have a 75 delta, and then I, on the same stock, my position is 750 delta, we're both bullish. You are just 10 times, or I'm just 10 times more bullish than you are. Okay, so back to position A, position B, 75 delta versus 750 delta. That gives me an idea of how much exposure I have. Now, here's the other interesting thing. Let's say position A is Apple. I have a 75 delta. Well, if you look at how much Apple moves, Apple has an ATR of $3. So typically per day, it'll move $3. Well, I can like take that times the delta, so times the ATR of 3. That basically tells me, look, I'm going to make or lose about $225 per day. Like that's the typical fluctuation for Apple. And so if I say, hey, I don't have the emotional capacity to handle my position moving $225 a day, like I'm going to puke or I'm going to freak out or I can't follow my rules. Well, what does that tell me? That tells me my position's too big. So apparently 75 delta is too much for Apple, right? Too much. Or maybe not. But the point is you can then make an informed decision, right? 750 delta sounds like a lot, but maybe this stock only moves, maybe the ATR is 25 cents. Well, 750 delta, if it's moving 25 cents a day, it's only moving $187 on average per day. So I can literally go into my portfolio and look at my positions, look at the monitor tab, and I can look at the delta. I can look at the delta of each position. Like SoFi, we have an 18 delta. Okay, so if SoFi goes up $1, this position makes $18. If SoFi goes down $1, this position loses $18. Not a big deal, not a very big position, right? And then I could go look at how much SoFi tends to move and make sure I'm comfortable with it. Because you and I, the way that we experience trading on a day-to-day basis, this is like a boxing match where you are in the ring and you are feeling every punch, every body blow, every right hook to the jaw or whatever. Like you have to be able to handle that to get to the end of the fight. You can't just fast forward to the end typically. And the power of those punches, the amount of pain you feel or pleasure you feel is equivalent to what your profit or loss is for that day, right? I have to be able to handle the daily fluctuations to get to the profit, hopefully at the end. And you can control those daily fluctuations in large part, by looking at the delta and making sure it's a number you can handle, right? Yeah. So that's the first point, okay? How you use delta on each individual position. The second piece is, well, I don't have one position. I have 7 positions. Or, in this case, I don't know, 15, 20. Like I got a lot of positions. So these start to add up, right? They're additive where each extra trade, assuming they're all bullish, gives me more and more exposure. So is there a way to measure all of it, the whole bucket, and be able to know in aggregate how much exposure I have? This is where things get a little bit tricky. So key point here is you can't add the delta of one stock to the delta of another. Okay, for 2 reasons. One, they have different share prices. $1 is the metric, is the constant. $1 is the constant. Delta is stated in terms of $1 moves. But a $1 move is not the same for every stock. For a $100 stock, it's a 1% move. For a $1 stock, that's a 100% move. A $10 stock could be a 10% move. So you got to adjust this based on the price of the stock. Okay. I spelled that wrong. Different share prices. The other, even if they had the same share price, they move different volatilities, which is usually expressed as beta. And so 2 $10 stocks, one moves 5% a day, the other moves 1% a day. You got to adjust for that. And so where this beta weighting comes into play is when you're trying to make adjustments to every individual delta for every individual position, so you can state that number in like terms and then add them together and actually have a number that makes sense, right? So by default, Thinkorswim does not do that. See, my delta column here says 2021. all it's doing is adding up the delta of USO to the delta of SoFi to the delta of DR Horton. It's saying, oh, well, we can do the math. Add all these up. You have 2,000 delta. 2,000 based on what? Does that mean if GDX goes up $1, I make $2,000? Or does that mean if silver goes up $1, I make $2,000? You just added up apples and oranges and bananas and told me how many grapes I have. It's nonsensical. It doesn't make any sense whatsoever. You can't do it. So you have to adjust those deltas. And so what you do when you beta weight, okay, so you beta weighting fixes this problem, okay? So you pick which underlying you want as the constant. And then it will adjust the deltas in terms of a $1 move for that underlying. So usually, we use the S&P 500, like SPY. And so what you do here is you come in and you click on this beta weighting button and you put in SPY and you hit enter. And then now at the bottom, what it'll do, forget the bottom for a second, it will change all the deltas in terms of S&P deltas. And so if the S&P goes up $1, I'll make $63 on IWM. If the S&P goes up $1, I'll make $17 on USO. If the S&P goes up $1, so S&P of $1 is the constant, and it's telling you how much each one of these will make or lose. Now, there's a slight error here with SoFi.
Kill your SoFi trade.
Yeah. So if I kill this, it should take it out, hopefully, and then give me the subtotal. But essentially that subtotal will now be a number that makes sense because now these are all apples to apples. And it says, okay, your 629 is your portfolio delta. So given all your positions, if the S&P goes up $1, you'll make $629. If the S&P goes down $1, you'll lose $629. Oh, well, that's interesting to know, right? Because now I can basically say, hey, the S&P tends to move $6. Get out of my way. I think that's 662. There we go. It's moving 662 a day. So a typical day, the S&P moves $6.50. If I have a delta of 628, Matt, my portfolio conceivably is moving $4,000 a day. Am I okay with that? Can I handle that? If the answer is no way, Jose, what does that tell me? It tells me I have too much exposure. My delta is too high. And so it's just fascinating when you start to know how to measure this stuff. You can make more informed decisions. You can be more comfortable. Part of the reason why Matt and I are able to be so level-headed when the market's a hot mess is because we've sized appropriately, and it just doesn't matter as much anymore. I have control over how much my portfolio fluctuates because I pay attention to these numbers. Right? So that's delta, that's beta weighting. There's your lesson for the day.